The game is officially over. For years, the silver community has been gaslit. We've looked at the suppressed charts, we've tracked the dwindling vault stocks, and we've hypothesized that one day the banking cartel would finally run out of runway. We said that eventually the paper promise would have to answer to the physical reality. But until this morning, that was just a thesis. It was a well-researched theory, but we were still waiting for the body to drop. Well, stop waiting. The masks haven't just slipped, they've been ripped off. While the world was distracted by the daily noise, the plumbing of the global financial system just suffered a catastrophic burst. We have just confirmed that the Federal Reserve was forced to quietly pump $21 billion into the veins of the world's largest bullion banks. This isn't liquidity, it's a confession. You need to understand the gravity of this. Healthy banks do not go to the Fed's standing repo facility. In the world of high finance, tapping that window is the ultimate walk of shame. It is the emergency room for a terminal patient. If these banks were solvent, they would borrow from each other. They aren't, so they can't. Why now? Why $21 billion? Because the silver shorts haven't just collapsed, they've been vaporized. The paper-to-physical divorce is finally final. For decades, they sold 400 ounces of paper for every 1 ounce of physical metal, thinking they could keep the lid on the pot forever. But the pot just boiled over. The $21 billion isn't a loan to grow the economy. It's a desperate margin call payment to prevent the COMEX from a total delivery default. They are trying to buy one more day. They are using your devalued dollars to subsidize their losing bets against God's money. But here is the fatal flaw in their plan. The Fed can print trillions of dollars, but they cannot print a single ounce of silver. Every dollar they inject to save the banks only proves why you need to own the metal they are trying to suppress. We aren't just looking at a price spike, we are witnessing the great reset of the precious metals market in real time. If you own physical silver, you aren't just an investor anymore. You are the only person left with a life raft. Today, we go inside the numbers. We look at the $21 billion thermal signature of a banking heart attack. And I'll show you why triple-digit silver is no longer a what if, it is a mathematical certainty. To understand why this 21 billion injection is the definitive signal of a systemic coronary, we have to look past the sanitized headlines and peer directly into the dark, greasy gears of the global financial plumbing known as the repo market. Most people hear the word liquidity and think of a refreshing stream of capital. They shouldn't. In the context of the Federal Reserve's standing repo facility, liquidity is the adrenaline shot delivered directly into the heart of a dying patient on the operating table. We are talking about the standing repo facility, the SRF, and if you want to know how close we are to the end, you have to understand that this facility is not a tool of high finance, it is the pawn shop of the elite. In a functioning, healthy economy, banks trade with one another. If JP Morgan is short on cash but has plenty of collateral, they call up Goldman Sachs or a regional player and say, "Lend me a few billion overnight. I'll give you a slice of interest and we're square in the morning." This is the interbank market, the neighborhood watch of the banking world. It relies on a single invisible ingredient, trust. When the system is stable, banks trust that their peers are solvent. They trust the collateral. They trust that the guy on the other end of the phone is not hiding a multi-billion-dollar hole in his balance sheet. But the moment that trust evaporates, the phone stops ringing. The interbank market freezes. And when your peers, the people who know your books better than anyone else, refuse to take your call, you have only one place left to go. You have to put on your suit, walk down to Liberty Street, and knock on the door of the Federal Reserve Bank of New York. You have to take the walk of shame to the emergency window. This $21 billion isn't a routine transaction. It is the ultimate admission of being unbankable. Think about the psychology here. A G-SIB, a global systemically important bank, will do almost anything to avoid the Fed's repo window. Why? Because the moment you touch that money, you are signaling to every other player in the world that you are radioactive. You're telling the market that no other bank on the planet was willing to touch your collateral or trust your word for 24 hours. It is a scarlet letter branded onto the balance sheet. For the Fed to report a $21 billion spike means that the masters of the universe are currently so toxic, so deeply underwater on their silver short positions, that they have become pariahs within their own private club. To visualize this, imagine the world's most prestigious jewelry store suddenly being forced to take the crown jewels to a local pawn shop just to pay the electric bill. That is exactly what we are seeing. The banks are taking their U.S. Treasury bonds, the supposed gold standard of collateral, and hawking them to the Fed for quick cash. But they are not doing it to invest in new technologies or to provide mortgages to the middle class. They are doing it because the silver market has turned into a giant, gaping maw that is devouring their liquid reserves. When the silver price gaps up, the clearinghouses don't care about your pedigree or your history. They demand margin. And they demand it in cash, not paper silver, not promises, not unrealized accounting tricks. Cold, hard cash. This $21 billion represents the exact moment the bank's internal cash reserves hit zero. It is the sound of the bottom of the barrel being scraped. We've been told for decades that these institutions are fortress balance sheets, that they are overcapitalized and prepared for any shock. But $21 billion says otherwise. It tells us that the silver short position is so massive, so leveraged at 100 to 1 or higher, that a mere move in the spot price has rendered the world's largest financial entities effectively insolvent on a mark-to-market basis. This is the thermal signature of a banking heart attack. You have to ask yourself, why now? Why this specific amount? In 2019, we saw a similar spike in the repo markets, and the system nearly seized up entirely. Back then, it was a general lack of reserves. Today, it is surgical. It is localized. The timing aligns perfectly with the total breakdown of the silver suppression mechanism. The banks are caught in a lethal pincer movement. On one side, they have the physical market in the east, led by China. And India, draining the COMEX and LBMA vaults at a rate we have never seen in history. On the other side, they have a surging price that is triggering automated margin calls. They are being forced to pay for silver they don't have with money they can't afford to lose. The standing repo facility was designed to be a backstop, a way to prevent a repeat of the 2008 Lehman Brothers collapse. But when the backstop becomes the primary source of survival, the facility is no longer a safety net, it's a life support machine. By pumping this $21 billion into the system, the Fed is essentially admitting that the too-big-to-fail banks are already failing. They are just trying to manage the optics of the collapse. They are trying to keep the heartbeat steady enough so that the general public doesn't look under the hood and see the smoldering wreckage of the fractional reserve system. The $21 billion. Walk of shame is the definitive proof that the silver market is no longer just a commodity trade. It has become a systemic threat. The banks have gambled the entire stability of the dollar on the idea that they could indefinitely suppress the price of a metal that is essential to the modern world. They bet against the reality of supply and demand, and they lost. Now they are standing at the pawnshop window, handing over the last of their treasury collateral, hoping that the Fed can print enough digits to keep the silver monster in its cage for just one more day. But the monster is out. The $21 billion isn't the solution. It's the siren. It's the warning bell that the end game isn't a future event. It's the reality of the morning. When the masters of the universe become the unbankables, the transition from a paper-based illusion to a physical-based reality is no longer a choice. It is an inevitable mathematical conclusion. If they were healthy, they wouldn't be there. If the silver market was liquid and under control, that $21 billion would be zero. The fact that it isn't tells you everything you need to know. The banks are out of bullets, and they've started throwing the gun. The pawn shop of the elite is open for business because the elite are officially broke. They are holding a massive pile of paper promises in a world that is suddenly demanding the real thing. And the real thing, physical silver, doesn't care about the Fed's repo window. It doesn't care about emergency liquidity. It only cares about the truth. And the truth is, the vault is empty, the check is about to bounce, and the walk of shame has only just begun. To truly grasp the magnitude of the $21 billion intervention, we have to descend from the ivory towers of the Federal Reserve and step onto the blood-slicked floor of the Commodities Exchange. This is where the abstract becomes physical. This is where the short trap finally snaps shut on the very institutions that built it. For decades, the bullion banks have operated under a position of absolute arrogance, believing they could control the price of silver through a simple mechanism of infinite leverage. Their strategy was elegant in its cruelty. Whenever the price of silver began to reflect its true industrial and monetary value, the banks would flood the market with paper contracts, promises to deliver silver they didn't have. By increasing the supply of paper, they could artificially suppress the price, trigger the sell orders of panicked retail investors, and then buy back their own shorts at a profit. It was a perpetual motion machine of wealth extraction. But the problem with leverage is that it works beautifully until the moment the market moves against you with more force than your collateral can handle. That moment has arrived. The short trap isn't just a metaphor, it is a mathematical reality defined by the ratio of paper to physical metal. When you are shorting silver at a ratio of 100 to 1, a 1-1 move in the spot, price is not just a 1-1 loss, it equals a 100 hole in your balance sheet for every ounce of physical metal you actually hold. As silver began its vertical ascent, moving from the suppressed levels of $30 to the $50, $70, and now higher, the banks didn't just see a dip in their profits. They saw a total evaporation of their liquid reserves. Imagine sitting on a short position of 500 million ounces. For every dollar the price moves up, you lose $500 million. When the price moves $10 or $20 in a matter of weeks, we aren't talking about a bad quarter. We are talking about a margin call on the system. A margin call is the most cold-blooded event in the financial world. It is a demand for immediate payment to cover potential losses. The clearinghouse doesn't care about your reputation, your political connections, or the fact that you have a seat on the Fed's board. The clearinghouse only cares about solvency. They look at the silver price on the screen, they look at your short position, and they calculate the risk. When that risk exceeds your deposited collateral, the computer spits out a number. That number is the price of admission to stay in the game. If you can't pay it, the exchange will forcibly liquidate your position. They will buy back your shorts at the current market price, which creates a massive wave of buying pressure, which in turn sends the price even higher, triggering even more liquidations. This is the short squeeze death spiral. And the $21 billion we just saw the banks borrow from the Fed is the exact amount they needed to stop that spiral from consuming them entirely this morning. We aren't talking about a standard market correction here. We are talking about the total liquidation of the shorting class. And these banks have spent years hiding these losses by marking them as unrealized. They would tell their shareholders and regulators, yes, the price is up, but it's a temporary spike. We don't have to book the loss because the price will come back down. They were kicking the can down a road that has finally hit a dead end. The $21 billion emergency injection is the proof that they can no longer hide the realized nature of their failure. The exchange demanded the cash, and the bank's internal ledgers were dry. They had been caught short out of physical. They couldn't deliver the silver, and they didn't have the dollars to cover the bet. The sheer scale of this $21 billion margin call tells us something terrifying about the level of leverage in the system. If $21 billion was required just to keep the lights on. For one morning of trading, imagine the total notional value of the short positions that are still outstanding. We are looking at a mountain of debt built on a grain of sand. The banks thought they could spook the retail investors into selling their physical metal, but the stacker movement did something the banks didn't predict. They held. They didn't just hold, they demanded delivery. They took their silver off the exchange and put it into private vaults and safes. This removed the grease from the system. Without physical silver to shuffle around to cover their paper promises, the banks were left naked. When a bank gets caught in a short trap of this magnitude, their first instinct is to double down. They sell more paper to try and tamp down the price. But this requires even more margin. It's like trying to put out a fire by throwing crates of dynamite onto the flames. Every new short they opened at $50 or $60 became a new liability the moment the price hit $70. They are now in a position where they are literally shorting the future. They are betting against the inevitable industrial demand for solar panels, electric vehicles, and high-tech weaponry, all of which require silver, while simultaneously betting against the growing global distrust of fiat currency. It is a bet they cannot win. And the $21 billion is the first major tribute that I've had to pay to the reality of the market. This isn't just a silver story. It is a story about the end of the infinite liquidity illusion. For a long time, the market believed the banks had infinite ammunition. We now have the thermal signature of their empty magazines. At $21 billion, this is a margin call on the entire fractional reserve commodities complex. If they are failing in silver, they are likely failing in gold, in copper, and in platinum. Silver is simply the canary in the coal mine because it is the most tightly coiled spring in the financial world. It is the smallest market with the largest amount of manipulation, which means when it breaks with a violence that shatters the surrounding glass. The banks are now in a state of forced participation. They cannot exit their short positions because the act of exiting would send silver to $200 overnight. But they cannot afford to stay in their positions because the margin calls are draining their lifeblood. They are trapped in a room with no doors and a ceiling that is slowly lowering. The Fed's $21 billion is an attempt to grease the ceiling and slow it down, but the weight of the market is too great. The silver squeeze has officially transitioned into a banking collapse. Every ounce of physical silver you hold is a weight on that ceiling. Every time you refuse to sell your life raft back to the people who tried to sink your ship, the margin call grows larger. We're watching a historic wealth transfer. The bank's losses are the physical holder's gains, but it's more than just a gain in price. It's a gain in power. The $21 billion represents a transfer of sovereignty from the centralized printing presses to the decentralized holders of hard assets. The banks are being liquidated, not just of their cash, but of their credibility. They have been caught in the ultimate lie, that paper is as good as gold and that a promise is as good as the metal itself. As the liquidation continues, the short trap will become a short grave. And as we move into the next phase of this crisis, we will see that the $21 billion was just the beginning. The clearinghouse is still calculating the numbers, and the price of silver is still climbing. The next margin call won't be $21 billion, it will be the entire system. To truly grasp why a $21 billion lifeline was the only thing standing between the global banking elite and total annihilation, you have to look at the irreconcilable rift that just opened up in the heart of the precious metals market. The great divorce between paper promises and physical reality. For decades, the COMEX has operated on a mathematical delusion. A high-stakes shell game where the house convinced everyone that a digital digit on a screen was identical to a kilo of 999 fine silver held in your hand. But this morning, that illusion shattered. We are no longer looking at a market price for silver. We are looking at the wreckage of a system where there are now 400 ounces of paper claims for every single physical ounce of silver sitting in a vault. This is not just a supply squeeze. This is a mathematical impossibility that has finally hit its 0 hour. The COMEX was never designed to be a place where people actually went to buy silver. It was designed as a price discovery mechanism for hedgers and speculators, a playground where cash settlement was the rule and physical delivery was the rare, annoying exception. The banks loved this system because you can print an infinite amount of paper, but you cannot print a single atom of silver. By flooding the exchange with hundreds of millions of ounces of virtual silver, they could drive the price wherever they wanted. They were selling the same ounce of silver to 100 different people, betting that those 100 people would never all show up at the same time and demand their metal. It was the ultimate fractional reserve scheme, but the standoff has ended. The paper-to-physical divorce is being finalized in the most brutal way possible, through a run on the vaults. The data we are seeing right now is haunting for anyone sitting on a short position. Physical silver is leaving registered vaults, the silver specifically set aside for exchange delivery at record speeds. We are watching a drain the lake event that has left the shorts standing on a dry bed of sand. The registered inventory has plummeted to levels not seen in decades, even as industrial demand from the solar and EV sectors is hitting an all-time high. This creates a delivery nightmare. When a contract expires and the buyer says, "I don't want your paper profit, I want the bars," the bank has to find that metal. If the vault is empty, they have to go into the open market and buy it at any price. This is the thermal signature of the $21 billion injection. The banks didn't have the metal, and they didn't have the cash to go out and buy it from the few people who still have it. They were left with nothing but receipts, worthless pieces of digital paper that no longer hold the power to command physical atoms. Think about the sheer audacity of a 400-to-1 leverage ratio. If only 1% of paper-silver holders demand physical delivery, the entire COMEX system collapses instantly. The math simply does not work. We are now seeing the big money, the family offices, the sovereign wealth funds, and the massive industrial players realizing that the paper price is a lie. They are no longer content with a digital entry in a ledger. They are taking delivery. They are moving silver out of the COMEX and LBMA systems and into private, unencumbered storage. This is a vote of no confidence in the banking system. It is the physical market saying to the paper market, your money is no longer good here. When the divorce between paper and physical becomes total, the paper price becomes irrelevant. We are entering a two-tier market. You might see a spot price on your screen that says silver is $77. But if you try to go out and actually buy a 1,000-ounce bar, you'll find that the premium is massive, or worse, that the physical availability window is slammed shut. This is what the banks fear most. If the world realizes that the paper price is a fiction used to protect the short positions of the bullion banks, the stampede out of the dollar and into the metal will become a vertical wall of demand. The $21 billion was a desperate attempt to keep the paper market linked to the physical reality for just a few more hours. But you cannot use a paper tourniquet to stop a systemic hemorrhage. The shorts are now holding a bag of nothing. They have sold promises to deliver to the entire world, and the world is finally calling their bluff. In the past, the banks could always find a friendly partner to lease them some silver to cover a temporary shortfall. But today, the friendly partners are hoarding their own metal. Central banks in the East are accumulating gold and silver at a pace that suggests they know exactly what is coming. They are preparing for a world after the paper divorce, a world where the only thing that counts as money is a tangible asset with no counterparty risk. The banks are staring at their screens, watching the registered silver numbers tick down toward zero, knowing that every tick represents another nail in the coffin of their manipulation scheme. This delivery nightmare is the climax of a decades-long struggle. For years, stackers have been told that silver is a commodity, not money. They were told that the paper market is deep and liquid. Both were lies. Silver is the ultimate monetary insurance, and the paper market is a shallow pool that has just been drained. The $21 billion isn't just a number, it is the price of the bank's hubris. It is what it costs to try and maintain a 400-to-1 lie when the truth starts walking out the vault door. If you are holding physical silver right now, you are holding the key to the system. You are the one who determines the price, not the computer algorithms in New York or London. The shorts are in a state of maximum vulnerability. They are short out of physical and short out of time. They are trying to use the Fed's cash to paper over the lack of metal, but you cannot build a solar panel out of a Fed repo agreement. You cannot build a missile guidance system out of a $21 billion digital injection. The industrial world needs the metal, the investing world wants the metal, and the banks only have receipts. The divorce is final. The paper market is going to zero in terms of its ability to command physical silver, while the physical metal is headed toward a value that reflects its true scarcity. This is why the Great Reset is already here. It's not a policy proposal from the IMF, it's a market reality. When the paper promises fail, the only thing left is the physical reality. The $21 billion was the last attempt to save the paper world. But as the vaults continue to bleed dry, the realization is setting in. The banks aren't just losing a trade, they are losing their grip on the world's most undervalued asset. The nothing they are holding is about to become very expensive. To understand the true scale of the $21 billion fracture we are witnessing, we have to look back at the ghosts of 2008. Most people remember the great financial crisis as a story of bad mortgages and suburban sprawl, a collapse triggered by subprime loans that no one could pay back. But when you compare the Lehman Brothers moment to what is happening today in the silver market, the differences are far more terrifying than the similarities. In 2008, the banking system bet on human error. They bet on the housing market and a pile of complex man-made derivatives. Today, they haven't just bet against a bad loan, they have bet against the fundamental physics of the universe. They have bet against God's money. And that is why this 21 billion spike is the shadow of a much darker monster than anything we saw 18 years ago. When Bear Stearns collapsed in March of 2008, it started with a liquidity freeze. The toxic assets on their books were mortgage-backed securities, paper contracts tied to the ability of people to pay their monthly interest. Those assets were fundamentally reprintable. The Fed could, and eventually did, simply print trillions of dollars to absorb those bad debts, swap them out for fresh cash, and pretend the whole didn't exist. It was a crisis of paper versus paper. But what we are looking at today is a crisis of paper versus reality. The $21 billion being funneled into the bullion banks is not being used to bail out bad home loans. It's being used to bail out a failed attempt to suppress a chemical element. You cannot print silver to fix a silver shortage. You cannot bail out a deficit of physical atoms. The Lehman moment was a shock to the system, but it was a shock that could be managed by expanding the balance sheet of the Federal Reserve. They flooded the world with liquidity and reflated the bubble, but silver is the Achilles heel of that entire reflation strategy. By betting against silver, the banks weren't just taking a position on a commodity. They were taking a position against the inevitability of inflation. They were betting that they could keep the ghost of 2008 in the closet forever by making sure that the ultimate barometer of dollar devaluation, precious metals, never reflected the truth. This $21 billion confession proves that the barometer has finally broken the glass. Think about the stakes. In 2008, if the banks lost, people lost their homes. In 2025, if the banks lose their short positions in silver, the entire concept of the fiat dollar loses its credibility. This is why the Fed is moving with such desperate speed. In 2008, the contagion was contained within the housing market for nearly a year before it exploded. Today, the contagion is localized in the very thing that is supposed to be the safe haven. If the banks are insolvent because they are short on God's money, there's nowhere left for the system to hide. You can't flee from a banking collapse into a currency that is being printed specifically to save the banks that are collapsing. It is a hall of mirrors that ends in a dead-end street. The $21 billion repo spike is more dangerous than the Bear Stearns moment because it represents a margin call on truth. Back then, the banks were lying about the quality of their loans. Today, they are lying about the existence of the collateral itself. They have sold 100 to 400 times more silver than exists in their vaults. When the 2008 crisis hit, the physical reality was a house that was worth less than the loan. Today, the physical reality is a vault that is literally empty. You can't foreclose on an empty vault. You can't restructure a debt that requires the delivery of a physical element that has already been shipped to Shanghai or Mumbai. This is a zero-sum game, where the bank's survival requires the laws of supply and demand to be suspended indefinitely. Furthermore, the geopolitical landscape has shifted. In 2008, the world still looked to the Federal Reserve as the adult in the room. When the Fed printed money to save the banks, the rest of the world followed suit. But today, the East is no longer playing along. While the Fed is pumping $21 billion into the pawn shop of the elite to save the silver shorts, the BRICS nations are aggressively hoarding physical metal. They are watching the shadow of 2008 return, and they are ensuring that they aren't the ones left holding the paper receipts. This makes the $21 billion injection not just a domestic bailout, but a signal of weakness to the entire global stage. It tells the world that the fortress dollar is being held together by a desperate attempt to manipulate the price of a metal that the rest of the world is using to build a new financial system. The shadow of 2008 is long, but the crisis of 2025 is deep. The bullion banks didn't just make a bad trade, they engaged in a decades-long war against the only asset that cannot be created by a central bank. They tried to replace God's money with bankers' math, and the $21 billion is the moment the math failed. When Lehman went down, it was a failure of the invisible hand of the market. This $21 billion spike is a failure of the visible hand of the Fed. They have stepped onto the field to play the game themselves because their players, the big banks, have been carried off on stretchers. In 2008, the slogan was too big to fail. In 2025, the reality is too short to survive. The banks are caught in a pincer movement of their own making. If they let the silver price rise to reflect its true value, they go bankrupt instantly. If they use the Fed to suppress the price, they destroy the value of the dollar even faster, which drives even more people into silver. It is a self-licking ice cream cone of destruction. This is why the current moment is so much more volatile than the subprime crisis. We are no longer debating the value of a house. We are debating the value of the currency itself. The $21 billion thermal signature we've identified is the smoke before the fire. In 2008, the smoke was the breaking news of a small hedge fund failing. Today, the smoke is a multi-billion-dollar emergency repo injection on a Friday morning. The banks have gambled everything on the hope that you would never realize that their paper silver is just a high-tech version of a subprime mortgage. They want you to believe that the system is stable, but $21 billion of taxpayer-backed liquidity says the system is in cardiac arrest. They bet against the one thing they couldn't control, and now the shadow of their failure is stretching across the entire global economy. This isn't just a repeat of 2008. It's the final chapter that 2008 never finished. The $21 billion injection we are witnessing is not a temporary bridge to a more stable future. It is the final desperate act of a central bank that has run out of exits. We have entered the era of the no-exit strategy, a state of permanent intervention where the Federal Reserve is no longer a referee, but the sole player keeping a dead game alive. Every silver stacker, every student of Austrian economics, and every person who has ever looked at a debt clock with a sense of dread predicted this exact moment. We called it the mathematical box. It is the point in the collapse of a fiat currency where the central bank is forced to choose between the life of the banking system and the life of the currency itself. Now, there is no middle ground. There is no soft landing. There's only the $21 billion siren blaring in the middle of the night, signaling that the Fed has officially chosen to sacrifice the dollar to save the banks that are short on silver. To understand the walls of this box, you have to look at what happens if the Fed tries to walk away. If the Federal Reserve pulls back that $21 billion lifeline tomorrow morning, the bullion banks die instantly. It is that simple. These institutions are so deeply leveraged, so short out of physical, that without a continuous stream of emergency liquidity, they cannot meet the margin calls of a surging silver market. Without the Fed's cash, the clearinghouses would be forced to liquidate the bank's short positions. This would trigger a supernova short squeeze, sending silver to triple digits in a matter of hours. The banks would be vaporized, their balance sheets erased by the very paper-to-physical divorce we've been tracking. The systemic collapse would ripple through every derivative, every pension fund, and every credit market in the Western world. To let the banks fail is to let the old world burn. And the Fed, which is owned by these very banks, will never allow that to happen voluntarily. But the other side of the box is even more lethal. If the Fed keeps the $21 billion in, and if, as we suspect, that number grows to $50 billion, $100 billion, and beyond, the dollar dies. By injecting billions of new unbacked units into the repo market to subsidize the losses of silver shorts, the Fed is fundamentally devaluing every single dollar in your bank account. They are printing money to fight the very asset that people buy to protect themselves from money printing. It is a self-defeating feedback loop. The more they bail out the banks, the more they destroy the purchasing power of the dollar. The more the dollar loses value, the higher the price of silver rises. The higher the price of silver rises, the larger the margin calls become, and the more billions the Fed has to print to cover them. It is a hyperinflationary spiral localized specifically in the commodities market, and the $21 billion is the first major acceleration of that engine. This is the mathematical box that the elites thought they could avoid through clever accounting and forward guidance. They thought they could manage expectations forever. But you cannot manage the expectations of a physical reality that is running out of atoms. The Fed is now trapped in a state of unlimited liability. They have become the counterparty to the entire silver market. They are effectively the world's largest silver short, but they are shorting the metal with a currency they can create at will. This would work if silver were just another paper asset, but silver is an industrial necessity and a global store of value. You cannot satisfy a demand for physical metal with a digital repo agreement. The world is looking at this 21 billion and realizing that the lender of last resort is now the spender of last resort. The Fed is spending the credibility of the United States of America to protect a group of banks that bet against the physical laws of supply and demand. The no-exit strategy means that the volatility we are seeing is the new baseline. There is no going back to the normal of $20 silver and quiet repo markets. To go back would require the banks to close their shorts, which they cannot do without sending the price to the moon. To stay here requires the Fed to print forever, which sends the price to the moon anyway. This is the checkmate moment that the silver community has been discussing for a decade. The banks have gambled themselves into a corner where their only hope for survival is a total reset of the monetary system, a great reset, where they hope to wipe out their paper liabilities before the public realizes the physical assets are gone. We are watching the death of the tamp down. In the past, the banks could use a few billion in paper shorts to scare the market, but now the market is no longer scared. The buyers in the East, the industrial giants, and the retail stackers have seen the smoking gun. They know the Fed is trapped. Every time the $21 billion number flashes on the screen, it acts as a giant buy signal for the rest of the world. It is a confirmation that the banks are weak, the Fed is desperate, and the silver is scarce. The Fed's attempt to provide stability has become the primary driver of the next leg up in the price. They are trying to put out a fire with a hose that is pumping gasoline. This is why the protagonist of our story, the investor, the stacker, the person who saw this coming, needs to realize that the doubt they felt for years was the result of a coordinated gaslighting campaign. They told you the Fed was in control. They told you the silver market was deep. They told you that the repo market was just a technicality. The $21 billion proves they were lying. It proves that the mathematical box is real and that the walls are closing in. There is no exit for the Fed, which means there is no exit for the dollar in its current form. The only exit is into the assets that the Fed cannot print, the assets that the banks are currently borrowing billions of dollars just to keep from rising too fast. The Fed is now a hostage to the silver price. Every morning, the governors wake up and pray that the COMEX doesn't see a spike in delivery demands. Every morning, they pray that the paper-to-physical divorce doesn't become a public scandal. But the $21 billion has already made it public. It is a thermal signature of a system that is burning through its last reserves of trust. The no-exit strategy is the final phase of any fiat currency. It is the phase where the intervention becomes the crisis. We are no longer waiting for the collapse. We are watching the collapse be managed by a $21 billion a day life support machine. And the most important thing to remember is that life support is not a cure. It is a delay. The end result is already baked into the math. The banks will break, or the dollar will break, and in both scenarios, the person holding the physical metal is the only one who survives the mathematical box. While the Federal Reserve is frantically trying to patch the leaks in the Western banking system with a $21 billion digital tourniquet, a far more profound and permanent shift is occurring on the other side of the planet. We have to look at the geopolitical fuse that has been lit. Because this $21 billion injection isn't just a domestic bailout. It is the ultimate signal to the BRICS nations and the rising East that the Western financial hegemony has finally run out of runway. While the bullion banks in New York and London are using the Fed's emergency window to shuffle paper and avoid margin calls, the East is doing something much more dangerous to the status quo. They are taking the metal. They are moving silver and gold out of the Western vaults at a pace that suggests they aren't just hedging against inflation, they are preparing for the total global wealth transfer that accompanies the death of a reserve currency. For years, the West has treated silver as a financial plaything, a derivative-heavy commodity that could be manipulated with a few keystrokes. But the East, led by China, Russia, and the growing alliance of the BRICS Plus nations, views silver through the lens of cold, hard reality. To them, silver is an industrial necessity for the 21st century and a foundational pillar of monetary sovereignty. While the Fed prints $21 billion to protect the shorts, the Shanghai Gold Exchange is seeing record premiums and massive physical outflows. The message from the East is clear. You can keep your paper promises. We will take the atoms. This is the geopolitical fuse that the mainstream media refuses to acknowledge. The West is subsidizing a failing paper market with printed dollars, while the East is accumulating the only assets that will survive the inevitable revaluation of the global monetary system. We are witnessing a strategic hollowing out of the Western world's physical reserves. Every time the Fed intervenes to suppress the silver price, it effectively puts silver on sale for the rest of the world. The BRICS nations are the primary beneficiaries of this manipulation. They are more than happy to watch the Fed devalue the dollar to keep the silver price artificially low, because it allows them to trade their export dollars for undervalued physical metal. This is the greatest wealth transfer in human history happening in real time. The American taxpayer is essentially funding a bailout that makes it easier for foreign powers to strip mine the West of its real, tangible wealth. The $21 billion isn't just staying in the banking system, it is leaking into the physical market, driving the paper-to-physical divorce even further as the East realizes that the Western vaults are increasingly filled with nothing but IOUs. The BRICS alliance is no longer a loose economic bloc. It has become a hard asset rebellion. They have seen what happens when the West uses the dollar as a weapon, and they have decided that the only way to protect their future is to anchor their economies to things the West cannot print. The $21 billion spike in the repo market is the only forensic proof. They needed to confirm that the Western banking system is hollow. In the boardrooms of Beijing and the central banks of Moscow, they aren't looking at the $21 billion as a sign of Fed strength. They are looking at it as a confession of insolvency. They know that a system that requires $21 billion in emergency cash just to survive a Friday morning in the silver market is a system that is one black swan event away from total disintegration. This geopolitical shift is why we are seeing the emergence of new exchanges and new price benchmarks. The East is tired of having the value of their resources determined by a handful of leveraged banks in Manhattan. By demanding physical delivery and ignoring the paper tamp downs, they are breaking the back of the Western price discovery mechanism. The $21 billion injection is the Fed's last-ditch effort to maintain the illusion of control. But it's a strategy that is backfiring on a global scale. Every dollar printed to save a silver short is a dollar that tells the rest of the world to get out of the greenback and into something real. It is a self-inflicted wound that is accelerating the de-dollarization of the global economy. Think about the leverage the East now holds. They have the manufacturing power, they have the raw materials, and now they are cornering the market on the precious metals required to run the modern world. While we are debating liquidity facilities and standing repo windows, they are building a world where the person with the physical silver makes the rules. The $21 billion bailout is the moment the mask fell for the global audience. It showed that the Fed is no longer the lender of last resort for a healthy world. It is the janitor of a failing empire trying to sweep the dust of a systemic collapse under the rug, while the neighbors are already moving the furniture out of the house. Image showing the contrast between Western paper claims on silver and Eastern physical holdings. This is why the protagonist, the individual investor, must look at the geopolitical fuse with a sense of urgency. You're not just competing against a bank, you are competing against sovereign nations for a finite supply of physical metal. The $21 billion injection is a neon sign flashing, "Get out," to anyone holding paper assets. The BRICS nations aren't waiting for a great reset to be announced by the IMF. They are forcing a reset by draining the physical liquidity of the West. They are playing a long game. The $21 billion repo spike is the evidence that the West has reached its endgame. The wealth of the middle class in the West is being sacrificed to keep a few bullion banks alive, while that same wealth, in the form of physical silver, is being shipped east. We are watching the pincer movement of the century. On one side, you have the internal mathematical collapse of the banking system, represented by the $21 billion margin call. On the other side, you have the external geopolitical rebellion of the BRICS nations, represented by the drain on physical vaults. The Fed is trapped in the middle, trying to use a printing press to fight a war on two fronts. But you cannot win a war of atoms with a weapon of ink. The $21 billion is a white flag, even if the mainstream media tries to frame it as a victory for market stability. It is a signal to the world that the West can no longer afford the truth, and that the only way to maintain the status quo is to print the currency into oblivion. As the geopolitical fuse continues to burn, the gap between the paper price and the physical reality will only widen. The $21 billion was just the spark. The real explosion will occur when the world realizes that the wealth transfer is complete, when the West wakes up to find that its banks are bailed out, its currency is debased, and its silver is gone. The East is prepared for that day. The question is, are you? The $21 billion is your warning. The global players have already made their move. They've traded their paper for your future. The only way to stay in the game is to follow the smart money and secure your position in the physical reality before the fuse reaches the powder keg. We have reached the terminal station of the fiat experiment, and the $21 billion emergency injection by the Federal Reserve is the final whistle blowing for the last train out of paper. This is the resolution of our story, but for the global financial system, it is the beginning of an irreversible transition. Throughout this journey, we have tracked the smoking gun, the pawnshop of the elite, and the geopolitical fuse that is currently burning through the foundations of the Western banking system. But now, we must face the most confronting reality of all. The window for obtaining physical silver at any price, let alone a fair one, is slamming shut. If you have been waiting for a better entry point or a pullback to reality, you have missed the fundamental point of the $21 billion confession. The reality is that the banks are broke, the Fed is desperate, and the silver is leaving the station. For years, the protagonist in this story, the stacker, the investor, the person who saw through the gaslighting, has looked at price targets like $30, $50, or even the previous all-time high as the ultimate goal. But in the wake of a $21 billion systemic bailout, we have to realize that those numbers are no longer targets. They are merely pit stops on the road to a total currency revaluation. When the system is forced to print $21 billion in a single morning just to prevent a delivery default, you're no longer measuring the value of silver. You are measuring the collapse of the dollar. In a hyperinflationary melt-up, which is precisely what the no-exit strategy triggers, the price of silver becomes a secondary concern. The only question that matters is, do you have the metal or do you have a receipt? The 21 billion injection tells us that the banks can no longer afford to let the paper price and the physical reality occupy the same space. As the last train pulls away, we are going to see a phenomenon that most modern investors are completely unprepared for: the total disappearance of physical availability. We have spent our lives in a world of just-in-time delivery and infinite digital liquidity. We assume that if we have the digits in our bank account, we can always click a button and buy whatever we want. But silver is not a digital asset. It is a finite physical element that is currently being devoured by industrial giants and sovereign nations. When the COMEX finally breaks and the 21 billion margin call is the sound of the hole ripping open, the spot price may stay at $77 or $100 for a while, but the physical market will simply go dark. You will call your dealer and the phone will ring unanswered. You will check the websites and every item will be marked out of stock. This is the resolution of the silver squeeze. It doesn't end with a quiet return to normalcy. It ends with the great reset of the precious metals market, where the paper price is abandoned as a fiction and the physical metal moves to a level that reflects its true scarcity. Now, $100 silver is not the end of the move. It is the moment the world realizes the banks have lost. It is the moment the gaslight fatigue finally lifts and the general public rushes for the exit, only to find that the last train out of paper is already at full capacity. The $21 billion was the bank's way of trying to buy one more day of silence, but for the alert investor, it was the loudest alarm bell in history. You have to understand the psychology of the end game. The elites know that a physical availability crisis is coming. They know that they cannot fulfill the 400-to-1 paper claims they have sold. Their strategy is to keep the price suppressed just long enough for them to secure their own positions, and for the Fed to move the too big to fail liabilities onto the public balance sheet. They want you to stay in paper. They want you to keep your wealth in the debasement machine so that they can use your purchasing power to fund their $21 billion bailouts. By holding physical silver, you are committing an act of financial rebellion. You are taking your wealth out of their pawn shop and putting it into a vault they cannot reach, a vault that doesn't require a Fed repo window to stay solvent. The protagonist of this story has a choice to make, and that choice must be made before the next Friday morning liquidity spike. You have the data. You have seen the thermal signature of a banking system in cardiac arrest. You have watched the East drain the West of its tangible assets while the Fed prints the difference. The resolution of this narrative is not something that happens to you. It is something you participate in. Secure your position now while the last train is still boarding. Don't wait for $100 silver to confirm your thesis. By the time the price hits triple digits, the physical window will likely be locked from the inside. The $21 billion is a gift of clarity. It is the moment the curtain was pulled back to reveal that the masters of the universe are actually unbankable entities surviving on emergency life support. This is the end of the era of speculation and the beginning of the era of survival. The game over screen is flashing for the bullion banks, but for the person holding the silver, it is the start of a new chapter of financial sovereignty. The Great Reset is not a threat to you if you own what the system is trying to destroy. It is only a threat to those who are still holding the receipts for a vault that has already been emptied. Take your place on the train, secure your family's future from the debasement machine. The $21 billion confession has given us the timeline, and the geopolitical fuse has given us the direction. The paper-to-physical divorce is being finalized this morning, and the only question left is which side of the settlement you will be on. This is the moment your thesis is proven right. This is the moment the skeptic within you is silenced by the cold, hard math of a $21 billion margin call. The train is leaving, the door is closing, the game is over, and the physical reality is the only thing left standing.